Good to go.
Thanks very much, Eric. Thank you, Ryan. Ladies and gentlemen, good morning and welcome. At this time, we'll call to order the quarterly meeting of the Lawrence County Retirement Board. Today is Tuesday, November 18 of 2025. A couple of housekeeping items. We are live streaming the meeting and recording the meeting. Would also ask if you have a cell phone, if you'd please put it on vibrate or silent. We would appreciate you doing that. Also note that the county code requires that counties of the fifth class have a board that oversees the retirement fund, and that board by law consists of the three elected commissioners, the county treasurer, the elected county treasurer, and the elected county controller. And today all five of us are here. So I'll call this meeting to order, and we'll begin with the Pledge of Allegiance and ask you to remain standing for a moment of silence. And Mr. Prestipine, could you lead us in the pledge?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Please remain standing. We'll have a brief moment of silence. Thank you all very much. Ryan, could you call the roll, please?
Controller Prestipine.
Here.
Treasurer Bone.
Present.
Commissioner Sanada.
Here.
Commissioner Kennedy.
Here.
Commissioner Vogler.
Here. Here, we have a quorum. We do set aside time for public comment, both at the beginning of the meeting and at the end of the meeting. And anybody who might have a public comment, we ask that it be related to the pension fund and retirement board matters. You're welcome to speak both times, one of the two times, or if you're just here to listen, that's equally fine. We ask that you try to limit your time to about 5 minutes if you could. Now, currently, there are no members of the public in the room, but if someone should come in, we'll certainly give them an opportunity to speak. But before I do that, let me see if there are any opening comments from my fellow board members, and I'll start with Mr. Kennedy. None. Mr. Rapone? Mr. Prestipine?
Nope.
And Mr. Sanada? No. Okay, thank you all, gentlemen. In the packet, we have the minutes from our last regular meeting, which was held on August 12. I have one minor correction. If you read this, it looks like Mr. Prestipine and Mr. Rapone did a minuet. Under approval of minutes, it says minuets. I don't remember you guys dancing. Yeah. So we'll make note that minuets should say minutes. Reminded of the old Three Stooges joke. Curly says, I come from a family of dancers. My father died dancing on the end of a rope. Anyway, the minutes of the August 12 meeting are in our packet. Gentlemen, once you've had time to look them over, could I take a motion, please, for us to approve?
I'll make a motion to accept. I'll second.
Thank you, gentlemen. That was Mr. Rapone moving and Mr. Prestipine seconding. Any discussion on the minutes? Hearing none, we'll take a roll call, please.
Controller Prestipine.
Yes.
Treasurer Bone.
Yes.
Commissioner Sanada.
Yes.
Commissioner Kennedy.
Yes.
Commissioner Vogler.
Yes.
Motion carries.
Thank you. Well, Sarah Wilson is with us today. I hope your drive up was uneventful.
Nice and uneventful.
No rain or snow or anything?
No, and I hope there's not the way back, so
That's
I gotta
right.
get to Harrisburg.
Oh, you're going to Harrisburg after this. We'll jump right into
No,
this.
we're good, we're fine.
Sarah, of course, is with Marquette, our Marquette Associates, the firm that handles the fund's investments. And as we do every meeting, you're here to give us an update, so we'll turn it over to you.
Thank you. I did pass out this article, which it's really good reading, and I think it really comes into play now since we've seen the last couple of days of the market. It's written by Greg, who is director of research. He's also a managing partner of the firm. And what's really interesting, it really is that S&P 500 from the January 1st, 2023 through mid-October, what do you think it returned percentage-wise? Any clue? No? Want to guess? 80%. So in this market, what we're saying is how can it keep going with that? And we look at all the volatility, so it's a really good read. Second of all, I did pass out the 2025 Pennsylvania County Database Review. You can read it, everything we've always kind of, sometimes we go over it, sometimes we don't, but it compares you to other counties. And I think you're in very good shape, so if you just want to see some of those where you are, you're right there. Let's open up, folks, and turn to Exhibit 2, the U.S. economy, page 10. And I think, you know, it's amazing how everything changes so fast. So this is for the third quarter. We have to understand that this is where your performance was driven from. But we look at U.S. real GDP growth, and there was a modest slowdown with in large part to smaller contributions growth from net exports. And we saw the quarter an uptick in consumer and government spending. So really, when we talk about this, we know that the government in the last couple of years is really one of the key points in upholding the market. And the consumer just keeps spending. We have seen a little bit of a retraction on that in the last couple of weeks. We talk about what's been happening with the tariffs. And we know that many economists, when the tariffs came in April, remember we saw that really back down in the market for those couple of days. But it bounced back up. We know that tariffs, the normal, the average is 18%. You know, with tariffs, it goes up to 34%. We have seen tariffs impact the consumer now, starting to, and then we've got a lot of policy that's saying, you know, they're going to get cut. We don't know if they're going to go in, but they've really had, the economy still remained resilient all the way through the end of September there. We know that there's been a lot of capital expenditure with AI, and if you look at the bottom of page 10, you can see who is contributing to year-over-year economic growth. And look at that. We look at the Magnificent Seven, the hyperscale, Alphabet, Amazon, Meta, and Microsoft. Look at the bottom of the second quarter of 2025, the contribution from the tech compared to the contribution of the rest of the economy. And so what it's saying is that this AI doesn't continue in the marketplace. It's only going to continue that much. We know that next year it's going to be about 17% increase of revenue expenditure growth, but then eventually it's going to kind of go like this. And what's happening with the rest of the economy? Can the rest of the economy still keep up? And if you turn to page 11, that leads into, we know that the one big beautiful bill, interestingly enough, you can see where the impact is going to have in 2026. So we're going to have the impact on economic growth. That's because of the tax cuts and the credits are largely front-loaded, but then the spending cuts are back-loaded. So once we reach 2028, it's going to have a negative impact on the economy there. And we talk about what's happened with CPI, and then the Fed. This is what's very interesting about the Fed. We know they cut at the end of September, and then they cut at the end of October. In September through October, those two cuts, we thought, well, there's really not going to be a cut again. 98% saw a cut in December at the beginning of the summer. Then it switched to only about 58% saw a cut in December. Now we're thinking there's going to be a cut again. So it's real, and that was large part that some of the data that we use, the Fed uses, is not possibly going to come out because of the government shutdown. But what we are starting to see is that inflation is starting to lower. We're starting to see a very soft job market. Not only we're seeing a soft job market, but we saw that like Amazon, UPS, and Target laid off 60,000 workers in the last month and a half. And what they're calling that is a white-collar recession, but they're blaming AI. So, you know, that's an interesting dynamic. We know AI took 3% of Microsoft's employees got laid off at the beginning of the year. So AI's got a lot to be involved in this, and we know that the Fed going forward, one of the chairs of the Fed, board member, said, I want you to cut more. One said, I don't want you to cut, and we know we're going to get a new chairman. So that policy is going to start changing. So we may or may not see a cut in December. And the market, well, with the market where it is in the last couple of days, and what's happened is that this is all AI driven. You know, you get one AI company, Magnificent Seven company, to miss their earnings ever so much, it turns the market, it spins the market out of control. And that is one thing that you've all done very well, is you've diversified your portfolios. Because if you had all of that towards that basket, it would be, you know, tremendous. You'd be up, down. So that's really looking forward, is going to be diversification, especially in the next 2 years. We look at page 12 and we look about economic growth. We actually saw some nice growth with your global managers. And you can see the forecast on that chart above as of April 2025 and of October 2025. So economic growth has actually improved globally. The forecasts are just slightly so higher. We've seen what's happening though with China and their fiscal deficit. Look at their fiscal deficit for 2025. Global growth slowed modestly from 3.2 in 2025 to 3.1 in 2026. We have seen that they have put in, Germany put into their economy a spending package of like 500 billion euros and stuff. So globally, we've seen companies putting into their economy and trying to get their economy going. So that has a nice effect when you look at your global managers. We look at page 13 and we look at what U.S. equities did, 8.2 for the quarter. Trailing 12 months did 17.6. Look at developed non-U.S. equities did 4.8, but emerging markets did 10.6. And we look at commodities were up. Commodities were did very well because of gold, but metal, besides metals, but energy and agriculture were in the red. I mean, if you think about it, crude oil's what, at 65, 66 a barrel. Not that Pennsylvania feels it at all. I mean, we really don't, you know. I remember it was like 89.90 and I'm still paying the same price. It's unbelievable that they have not solved that. That's just my little take on it. So, but we've seen crude oil be, fairly low there, which is going to help most of the country and with heating going forward and everything. Their agriculture was off. And we turn the page to page 14, we can look at the sector returns. Look at consumer discretionary. And consumer staples that were off 2.5 for the quarter, energy, financials were up 21.5 for the trailing 12 months. And we know that financials do very, very well in a higher interest rate market, so they're going to have a little bit of a bump, except they're going to, with the lower interest rates, everybody's going to go possibly refinance. The problem with that now, as we've seen, is that the real estate market is kind of like this. It's not gone up tremendously, but it's not gone down. But everybody's so in debt that even if they refinance, they're probably not going to be able to take all their credit off the books when we look at that. And we look at what's been happening, consumer services, consumer discretionary, and obviously information technology outperformed the broad market. From a style perspective, growth, yet again, outperformed largely due to the mega cap growth. What is interesting, and we're going to talk about this, the small cap has struggled, and we're going to talk about your manager, because your small cap manager has really struggled. When we look at small cap managers, the average small cap manager of 25 in the United States, when we take the big small cap managers, have returned a negative 10% to the relative benchmark. It's because interest rates were high. We know that small cap managers look for deals and look for companies that are going to borrow and grow. So it's been an extremely hard environment. Going forward, we like small cap, small and mid cap. We think that's where you should be as an active manager in U.S. equity. And the reason for that is you're not going to find a large cap manager that benches to the S&P 500 that is going to outperform consistently or outperform their cost. So when we knew that, we know they have struggled. Now we know that the Fed's cut rates. We look to small cap to come back. And it's been a hard market. And we are looking at our small cap managers every week. there's nobody to outreplace them. So long-term, they've done very well, but this year they have struggled. And it is noticeably taken down the equity performance just ever so slightly versus the benchmark there. And you can see what's happened is, look at the bottom of page 14, look at unprofitable companies and profitable companies since July. Look at the difference of that, and that is the AI dominance of what's happening with AI. And I think we need to step back and look at what's going to happen with AI. AI's been great. Are we able to have the infrastructure to continue to support? So it's just build, just develop. But then you've got to have the data centers and you've got to build. That's one reason why infrastructure is going to do very well for you. We also know that it's going to be an interesting environment when you're starting to look. We had WCM, who's your new global manager, came in last week, the portfolio managers talk, and they're not a big fan of AI. They've done very well. They're a fan of some of the companies that are going to support AI. And a lot of managers are saying, okay, we know we've got to have some exposure to the Magnificent Seven, but there are other companies out there, there's other ways to take advantage when we're building our portfolio. And if you think about in 2-3 years, we are not going to have the infrastructure to support AI. So what do you do? Where do you see that growth? So energy will grow, and companies that are going to support that will probably do very well in this market. Therefore, your small caps are probably going to start to continue to do very well. And we look at the narrative, page 15, and we look at the magnificent stocks are projected to be more than $600 billion this year. Capital expenditures 32% higher than last year, an increase for future 2026. I think this is what's interesting. Look at the top there, and you can see in the video it's really kind of fallen off the scales. And when we look at spending, we look at rates of return, and we look at what has happened there. And we have decided to, when we go back, and this is why you want to be diversified there. The other issue we have on the table looking forward with the economy is the consumer, what's going to happen with the consumer, the soft labor market. And really, there's a lot of policy. We know the government shutdowns ended. Pennsylvania, thank goodness, has passed the budget. But then we're going to have to see what's going to happen in the next 2 years. Because we know the first 2 years of a new administration, kind of washes out the last 4 years of a different administration. So now we're going to see the next 2 years and what's going to happen. And it's going to be hard to justify a lot of spending when you don't have the money to spend and when you have a weak labor market. So going forward, I think you're doing very well. You're extremely diversified, but I think this market is going to be hard to upkeep because it's been a great market through September 30th. October was a great market. And the last couple of days just kind of gave away October's right now. Are there any questions? All right, let's go see how you did. So let's go to the next exhibit. And you returned for the quarter 5.2 with a gain of 5.7 net of all fees. And you ended up on 9/30 all-time market high at $115 million. Year to date, you returned 2.3 with a net investment gain of 12.8 since Marquette's been here. You've annualized return of 8.2 with a net investment gain of $78 million.
And for the benefit of anybody that might be watching, you say that the annualized return of 8.2, that's a percentage figure, right?
Mm-hmm. Yes, so you annualize 8.2. Remember, your goal is really our goal when we say your actuarial assumption is a lot lower than a lot of other accounts. Goal is about 7.25. We do that consistently. You've met your actuarial assumption, and that's really what your pension fund. If you meet your actuarial assumption, annualized over 10 years, you're going to stay funded. You're really good, and you're very healthy. You've lowered your actuarial assumption, and you've had a lot of gains. You've made some really good decisions, also with diversification. Positive attribution for the quarter was WCM and MS, Fixed Income Manager Lord Abbott, and Defensive Equity Composite. Negative is U.S. Equity Manager Eaton Vance. That's your small cap, and we will look at that and talk about that. We replaced the remaining position of ours in July with Global Manager WCM. So at the beginning of the quarter, second quarter, we went and we looked at Artisan and we said, okay, we're gonna kind of lower Artisan. We had the choice of taking it all off the table or as consultants. A lot of us, I know I did, made the decision, let's keep Artisan in there, half of it. 5%, we went down to 2.5. Let's put WCM and see if they start to turn things around. Well, then what happened was we got notice that the portfolio manager, but when you've got hard time meeting expectations, your performance is bad, and you get a portfolio manager dumping, you fire them. So we fired them literally the next day, and we moved your entire position into WCM. We also then made it from a mutual fund into a CIT, which also saved you about 35 basis points. So they did that because we moved so much money there. At the end of the quarter, we moved WCM to CIT, as I said, and then low investment management annualized 0.27 basis points. Looking ahead, just review your Pennsylvania database. And then page 23, you can see how you've done versus the market. And you're off only by 20 basis points for the quarter, and then year-to-date was 0.5, and a large part of that was really, really driven by your underperformance from Artisan, which we got rid of, and from Eaton Vance. Are there any questions so far? All right, let's turn to page 28 real quick. And you can see where your managers are versus the public database, your asset allocation, and where you rank on that. And we look at that and we look at your rankings, and that means you're taking a lot less risk. And then we look at page 29 and you can see where you rank versus all public database plans that are in this composite. And you can see that you've done fairly well. You're ranking above the median there for 10 years. You rank at 27 with less risk. And then we turn the page to page 30, and I just want to point out 2022 was a double-digit down year, and you were down 12, and your policy index was down 13.6. And you were in the first quartile. So you did very well there. Let's turn the page to page 32 and we'll talk about performance. So we look at US equities and we look at Eaton Vance. They were down 3.6 versus 9% for the quarter. Year to date down 4.9 versus 9.5. So that had a drag on performance. But then we move over and we look at since inception, since we put them in 2014, they've annualized 10.7 versus 9.2. They're fine. This is what we're expecting, what we're looking at. We talked to the portfolio management team. They are not making any changes first of all, to the team, what they're investing in. They believe in what they have and what they're holding. It's just this market right now for them. So that's when you really have to understand when you do your research on the manager. So normally, a lot of times back in the day, you'd say, oh, absolutely not, we're just firing them. I can't do that. But there's no point to do it right now. And we were very, very comfortable with them. You can see what they've done. So they've done well. We go to the next page on 33, Global Equity Composite. You can see Dodge and Cox trailed a little bit, and that's because they are very concentrated in the stocks they hold, but year to date they did 20.4 versus 17.7. WCM is down 11.6 versus 9, and since we put them in March, they've done 22.9 versus 19.1. We are looking at them to do an active U.S. equity strategy for us, and also the global. We may be able to, depending on size, move you into an active strategy, meaning not just have the CIT, but be a separate account. So we're working on that in the next 12 months. MFS, yet again, 3.8 versus 1.1, year-to-date 14.9 versus 10.5. Non-US equities, EFA is trailed slightly, but it's done still well, 8.9 versus 10, but year-to-date 24.1. Real estate has done well for you. Remember, real estate, we said between 5 and 7%, it produces a nice dividend. You can see it did 0.9 versus 0.5. and then 3.2 versus 2.2. We know for the trailing 3 years, real estate was down over 6%. We knew that was gonna happen with interest rates going on and then, them having to change how they invested. But you can see through March, since we put them in, they've averaged 4%, which is not bad, because remember, you took half of that from fixed income. And this also gives you a nice dividend. If you, and took the volatility out of your portfolio. Page 34, Clarion is right there as well, and you can see TA Realty property. Infrastructure, 2.7 versus 1.4, year-to-date 5%, 3 years, 9.8. And since we put them in April 2022, and we funded this with half of fixed income, 9.6 versus 6.7 annualized. Defensive equity has also done well. So remember, infrastructure, real estate, defensive equity are all asset allocations that you made those changes and have done very well for you and for the plan. And you can see trailing 3 years, defensive equity has done 16.3 versus the market of 14.7. Fixed income, and this is when we look at fixed income, we put C.S. McKee in June 2022. Year, they've done for 3 months 2.1, year to date 6.3. So we've had a nice year for fixed income, and Baird Core Plus Fund has also done 6.3, and 1 year they've done 3.5. We put them in September 2024. We think they've got a really nice fix around C.S. McKee's fixed income. They fit very well with C.S. McKee, so they're working together. And then we also have the US Bond Index Fund, and you kind of have to have an index fund in there because it's so hard for active managers right now in this environment. It has been for fixed income. You just also put a little bit in the index and you get what the index is doing. Any questions? You're in good shape. I think next year will tell, hopefully this year. Fourth quarters are supposed to be nice. Remember last year, we came in, we said, oh, there's gonna be the election, everything was gonna go well. And then December ended up just going down, down, down. So we ended up with a negative fourth quarter, which is pretty rare. So hopefully this year it will just stay flat from where it started in October, and then you'll have had a great year.
Now, one of the phrases we always talk about is the fund being quote unquote fully funded. And I oftentimes look at Mr. Prestipine and you, is it safe to say at this point we're still fully funded? And you hit the 100% mark. Are we slightly above it right now?
Slightly below, we are slightly below much, it's like 99%.
Okay. We're extremely.
Actually, yeah, that's the actual number.
Yes. Okay. Thank you, Dave. Let's see. You asked for questions. We'll start with Mr. Sonata.
I really don't have any questions. I think you were very thorough. But I think you're doing a good job and you're doing what has to be done.
Thank you, sir. Controller Prestipine.
I'm good.
Thank you. Mr. Rapone.
None, thank you.
Mr. Kennedy.
No, I'm good.
Okay. Well, if these four are all happy, then I'm happy.
Well, there you go.
But it does sound like a good report, considering all of the noise you hear out of Washington. In spite of all that, we're holding our own.
Well, and that is the one thing is like volatility. This has been an extremely volatile market, and not always beating the benchmark, but really what it's to do is to keep you kind of right there, getting good returns in an up market, but not taking a ton of risk. And that's when the market goes down, is where you'll see this kick in much more.
And since you've been with us, that's been the case, which I know we greatly appreciate. We have a couple items of new business. Now, Sarah, you're welcome to stay. I know you've got to head to Harrisburg.
I'm good, don't
So,
worry.
Okay, but if you don't believe, I think we all understand.
I'm good.
Okay, well, thank you again so much, Sarah. The following proposed resolutions have been given to us by Controller Prestipine. Let's start with the first one on the agenda, which is the motion we would need to take, or the movement we would need to take to engage the services of Campbell Durant legal firm, but what number, do you know, we have a number for this one?
Number 3.
This is proposed resolution number 3 of 2025 for the retirement board. And Mr. Prestipine, if you don't mind, I'll turn it over to you for some background.
Yeah, this is basically just a fee agreement with Campbell Durant for legal matters, for anything that our solicitor is unable to handle or feels more comfortable with somebody with more expertise in retirement.
And there is an attachment dated September 19 of 2025, submitted to us by Mr. Brian Gabriel from the Campbell Durant firm. And I know the county has utilized their services for other matters, and we've always been very satisfied with the services that they provide. I'll start with Mr. Rapone to see if he has any questions. Thank you. Mr. Kennedy?
None.
No? Mr. Sanada? None. Okay. David, you're recommending approval.
Yes.
Having heard that, gentlemen, this is proposed resolution 3. May I have a motion?
I'll make a motion. I'll second.
Thank you both. Any further discussion? If not, we'll take a roll call, please.
Controller Prestipine,
Yes.
Treasurer Rapone,
Yes.
Commissioner Sonato,
Yes.
Commissioner Kennedy,
Yes.
Commissioner Vogler.
Yes.
Motion carries.
Thank you. The next item would be proposed resolution 4. And, hi Debbie.
Aye.
This would be for the county retirement board to enter into an agreement with West Banco for a service known as Positive Pay at a cost of $95 a month, which that cost would come from the retirement fund itself, right? Not from the county's general fund.
That's correct.
So David, I'll turn it over to you for background if you would.
This is basically something we've been looking into across the county. It's a service that it's been around for a little bit. The West Banco has recently offered it to us. It basically protects against check and ACH fraud. Nobody can mess with somebody with a check and get all the information, all the checks we write, all the ACHs we send. And if they get something back to them that doesn't match, they kick it out and let us know, and then we're protected against any kind of fraud.
Thank you for that information and also for the work you've done leading up to it. I appreciate that. And I'll see if Mr. Sanada has any questions.
No, I think we've talked about this, and I think it's important because especially today with all the fraud that's out there, we don't want to put the county at risk, so I have no issues.
Thank you, sir. Mr. Kennedy? No? Mr. Rapone? Okay, thank you. This is proposed resolution 4 that the controller has presented to us. May I have a motion?
Make a motion. I'll second.
Thank you both, gentlemen. If there are no other concerns or comments, we'll take a roll call, please.
Controller Prestipine,
Yes.
Treasurer Rapone,
Yes.
Commissioner Sonato,
Yes.
Commissioner Kennedy,
Yes.
Commissioner Vogler.
Yes.
Motion carries.
Thank you, Ryan. Proposed resolution 5, according to this wording, the retirement board each year is required to set the county's authorized rate of interest to be credited to member accounts. And if we approve this, this would take effect on January 1 of 2026. I'm going to turn it back over to Mr. Prestipine for his information and potentially a recommendation from you.
Yeah, as Commissioner Vogler said, we're required to set the interest rate every year. Currently, our interest rate is at 4.25%. With interest rates coming down, you know, with the Fed lowering interest rates recently, I would be comfortable keeping it where it's at now. Everybody else is in agreement.
That would be your proposal, your recommendation to the board, is keeping it at 4.25%. I'll start with Mr. Kennedy for any questions. No, sir, thank you. Mr. Rapone?
I do have a question.
Certainly.
Where do we stand with other counties for the best counties that with their interest rates normally are? Where do we
Is that
fall into
I don't know about
that?
that. She has it in the book.
The average increase is at 3.9, that was for last year. A majority of participating counties, 32 of 48, now use a salary increase assumption below 4.5%. And the average is 3.9 with all of them. And you can actually go to page 8 and you can see it, which you can see where it is, it's about 3.50.
Thank you.
Does that help you,
Yes,
sir?
it sure does. Thank you.
Okay, thank you. And let's see, I think, Mr. Kennedy, questions? Did I'm sorry. Who did I miss? Did I? Okay, I apologize.
You're good now. I'm fine with it.
So, thank you all, and this is proposed resolution 5 that will continue the percentage rate of interest to be credited as member accounts at 4.25% effective January 1, 2026. May I have a motion?
I'll make a motion.
Is there a second?
I'll second.
We'll give it to Mr. Prestipine for a second. Thank you, gentlemen. Are there any other concerns or questions? Hearing none, we'll take a roll call, please.
Controller Prestipine?
Yes.
Treasurer Cone?
Yes.
Commissioner Sonato?
Yes.
Commissioner Kennedy?
Yes.
Commissioner Vogler?
Yes.
Motion carries.
I want to thank Controller Prestipine. Now, according to county code, he serves as the secretary of this board. But matters like this, we appreciate your paying attention to and making sure we're doing the right thing at the right time. So, and Debbie, just to summarize Sarah's report, which I have a copy for you, but the bottom line for the county's retirement fund that as of September 30, the market value of the account was $115 million. In the third quarter of this year, the fund saw a return of 5.2%, which was a gain of $5.7 million. And year to date, starting January 1 up through the end of September, the fund saw a return of 12.3%, and we gained $12.8 million. And right before you came in, we were discussing the fact, is the fund fully funded? And the answer would be yes. Which some counties aren't able to make that claim, are they? Some are, but some aren't.
Yeah, some are really struggling.
So we're in a very fortunate position. And that should be an assurance to particularly our employees and our retirees and taxpayers overall. I have Sarah's documents for you, and I have the documents from the meeting that the commissioners had earlier this morning, which I'll give to you. But that being said, I'm going to drop down to item Roman numeral 6 to take public comments. So Debbie, anything? No? Okay, thank you. Closing comments from well, I'll start with Sarah. Any closing comments, Sarah?
No, thank you. We want to wish everybody a happy holiday season. I'll see some of you over the weekend.
Yes, we look forward to that, and I believe we will convene again unless we have to sooner. We meet quarterly, so I believe February. And we'll get that out to everybody, and we'll be doing a legal ad at the beginning of the year, noting this board does meet 4 times a year on a regular basis, so we'll have a legal ad to that effect. Final comments from my fellow members of the board, and I'll start with Commissioner Kennedy. Yes, sir. Thank you. Mr. Rapone.
No, thank you once again, Sarah. Happy Thanksgiving, Merry Christmas.
Thanks, Rich. Controller Prestipine.
Good, thank you, sir. Seems like everything's in good shape.
Thank you. And Mr. Sonata.
I'll echo Controller Prestipine's comments. Keep this up, and we'd like to hear you 100% done.
So do I.
We wish you safe travels to Harrisburg. Hope we didn't hold you up.
No, I'm fine. Got like 3 podcasts and I'm really.
Thanks for everything, Sarah.
Thank you. Good to see everybody.
Thank you. There being no other business to be brought before the board, may I please have an adjournment motion?
I make a motion to adjourn.
I'll second.
Thank you. All those in favor of adjourning, please say aye. Aye. Oppose the same sign. The motion carries. This meeting is adjourned, and you need to see all of us.
2 minutes,
Okay.
yes.
Okay, thank you. Thank you, Sarah.
You're welcome.
And
Happy holidays.
Happy holidays.
thank you, Debbie, for,
See you already.
thank you, Bill.
Bill, how are you?
Good.
Okay, I will.
Despite your things.
Perfect. I got it.
Sarah, how are you? Have a great holiday.